Welcome to the daily update, where I'll go over the action in the market for Thursday, February 6th, and we'll see how things look for Friday, February 7th. Another slow day. We're still above average with volume, but there's probably some apprehension ahead of the employment situation report that's coming out. But when you look intraday from last Monday after we gapped lower, set the low, we've been just chopping our way back up. We're staying positive in that regard. Our smart money indicators are pretty strong right now. In fact, too strong. And I'll show you those charts. We're getting extreme with all three of them. So we'll just keep an eye on that, wondering, okay, are we seeing some exhaustion at that level? Some of our moving average studies did decline on Thursday, but we're still holding up for the most part and looking positive because we're above the 20, 50, and 200-day moving averages. Okay, so right at the open, we had a higher open. Not much of a gap, but we did move up. But we hit resistance right away at R1 at 6,081. Then we fell back and we found support at the unchanged level. Now we have these things every day called pivot points. When we're going up, they're known as R points or resistance points. When we're going down, they're S points or support points. Built into that most of the time is the unchanged level itself. We could have a positive day, we start to fall back, we come down to the unchanged level, and then we bounce back up. It can also act as resistance on a down day. So that's kind of an additional level that is often used. Then as the day went on, we stayed below R1. We just chopped sideways, and then we saw some weakness coming in. We fell back below the unchanged level to go negative, but then we found support at the daily pivot at 6,044. Then we saw some late day buying, and this is encouraging when we see prices moving up as we're heading into the close. We got back above the unchanged level to go positive again. We got above R1 and we closed a little bit above R1 at the intraday high. So another day where we're setting the high right at or near the close. We were up 0.36%, not much of a move there, and we're still above average with volume. We are positive in the short, intermediate, and long term when you measure things on moving averages. But yeah, there's some weakness, and we're not trending right now. We're still going down with our ADX indicator. And of course, a lot of things that are really hitting the news cycle are the executive orders and the changes and the confirmations and different things that are happening right now. And as I've been saying, it's so fast that folks are having a hard time really keeping up with it. If you like what's happening, you're probably really happy about things. If you don't like what's happening, you're probably quite angry right now. So that's just what was promised, that there would be lots of changes quickly. And so it's probably going to continue. I mean, one day we're talking about Gaza, the next day it's shutting down USAID from sending out emails for federal employees to take a severance package. I mean, it's big, big, big things that are happening every day, and a lot of folks are feeling quite overwhelmed by that. Some are overwhelmed in a good way, some are overwhelmed in a bad way. Okay, so some comments. Mega caps did have a pretty good day on Thursday. That's really what drove things, especially near the close. The mid caps and the small caps, they underperformed. We're dealing with that 50-day moving average again with both of the indexes for the small caps that we look at. And since interest rates went back up a bit, not very much, we're still under that 4.5% level, but that might have pressured some things. So we're still just treading water as far as the mid caps and small caps. We haven't really broken out. We're still under 4.5%, which this is when it started to create a problem, when we started to climb above 4.5%. Now that we're coming back down below 4.5%, that is helping stocks for the time being. Now we have a kind of a long list here in the short term of overbought indicators. One of those is an oscillator, and this has been on the list now for a while. And we were turning more negative with the slope oscillator. That's a short-term oscillator. Now it's starting to turn back up, but it's still looking extreme positive. And then Then a new addition here is the balance of power. It's starting to get extreme. And then we have our three smart money indicators, the accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. All three of those together are pretty extreme right now. It shows that the smart money is coming in and buying, but we're seeing a little bit too positive readings with those. Now, you could put those in the intermediate term, but because we're not trending right now, decided to stick them over in the short term. And then we have this thing called a mass index, another indicator that's set up all of its criteria and it has triggered a signal that may suggest a reversal. But that was triggered a number of days ago, well back into last week, possibly the week before, and we haven't seen that reversal yet. So I'm not showing the chart anymore. I'll still keep it in the list for the time being. But the further we get away from those criteria being met, the more irrelevant it becomes. No change to the scenario. We'll see if the employment situation report feeds into that, either by showing that the economy is looking too strong and the Fed may continue not cutting or pausing their rate cuts, or if it's getting too soft, that market may like that because now maybe the Fed will need to come in and actually cut rates. Or if we get a mixed picture, it'll just kind of keep the scenario about the same. We were down with the dollar and interest rates were up. We're at 4.44% after we had been at 4.42% with the 10-year yield. The takeaway is that we're still below the 4.5% level for the 10-year yield. We ticked up one notch, not much of an improvement there. We're at 41 as far as sentiment, where we had been at 40. Still not real positive in that regard, which could end up working to the advantage of the market. If you have a lot of people that are skeptical, the market likes to climb a wall of worry. And if folks are worried that the market's going to go down, quite often it will end up doing the opposite of that. We're still not trending with our ADX, but we are positive. The green line is still above the red line, but the ADX is below 20 and declining below its moving average. We're positive with bias because of the update, and I've switched our momentum over to mixed to positive. We're seeing some under the surface concerns right now, and especially with some of these extreme positive readings with our smart money indicators. And we're not falling apart by any means, and we're still mainly looking positive, but because we're not in a trending environment right now, there's really no conviction going on. So that's why I stuck with the mixed, but yet things are leaning more in the positive direction. Economic reports that came out, we got the productivity for the fourth quarter came in 1.2%, and that the market liked that. Companies are being more efficient. They're producing more, and they expected it to be up 0.8%. Last time it was up 2.3%. So the reading was down from the previous reading, but it still came in stronger than what was expected. Unit labor costs, this could be a little bit inflationary here. It came in at 3%. They expected 2.6%. Last time it was up point half or half a percent there. Then we also had the weekly jobless claims, 219,000. They expected 213,000, and it's up from the 208,000 that we saw last time. But we're not seeing any real bust out to the upside or to the downside right now. They're just kind of holding steady for the time being. Continuing claims, this goes beyond the first week at 1.886 million. Last week it was 1.850 million. So we did see a tick up there, and I'll have charts to show you of these. Here is the non-farm productivity on a year-over-year basis. It puts productivity and unit labor costs together. So when you calculate it on a year-over-year basis here, the unit labor costs are coming down, but the productivity, even though it increased, is still going down on a year-over-year basis there. Then looking at the weekly jobless claims, they did go up, and we're starting to go back up with the moving average, but we've been in this range now for quite a while, going back well, the last year. That's what's shown on this chart. So we're not really seeing, we drift up and then we drift down. We're not really seeing any major moves either up or down with this. And we're starting to go back up here with the continuing claims. The moving average is going up, and we did see an increase. This is the one where we want to keep an eye on this longer term. If folks are getting laid off from their jobs and then they're having a difficult time finding another job beyond 1 week, that's where we're starting. If we see that, that's when the economy will probably show some signs of problems. And then this plots them all together. We will get an update of the unemployment rate in Friday's session with the employment situation report coming out. In red are the jobless claims, in blue are the continuing claims. This is just to give it a little bit of context by putting all three of these on one chart. Then, for some reason, at Isabel Net, they focused on households and how much stock they own here. And this just shows probably what's not really a surprise. If you're in the top 1%, they own the most stocks, where 90 to 99%, that's the green area. And then when you go 50 to 90%, that's the bottom area. So, no real surprise here, and it hasn't really changed. This goes all the way back to 1990. A similar thing here, it says the top 1% of households by wealth, they own 61% of stocks, where the bottom 50%, they own 4%. So, okay, there's a real disconnect between the two, which, kind of goes that way in a capitalistic society. But at the same time, another takeaway is most people are involved in the stock market. So it's to their benefit to at least understand what's going on. And one of the things I like to do with my videos, even though they're longer and they take some more effort to watch them, I do have a few folks that they don't necessarily actively participate in the market. They may do some dollar cost averaging or some kind of a program where they're putting money into retirement every week or every month, but they still find these videos useful because they can just kind of watch one of them and get caught up with where things are happening and what the shape of the overall stock market is. And then another one, the ownerships of stocks, a total percent of assets. Now, folks, people have their assets in their home, but we're up just a little under 30% here. And it's getting to a pretty high reading going back to the 1950s, with stocks being another major part of household assets. Then the cumulative trailing 12 months. Now, this is looking back where the stock market looks forward. And I go over this in the weekend video that talks about intermarket analysis, but it's showing the money's really going into money markets, and it's not necessarily a parking place to go into the stock market. Some folks are putting money into a money market because that's still giving them a better yield while still keeping it liquid. They might have a debit card or a checking account or something attached to a money market than what they would be getting at their bank. And so they're finding it more attractive to go into a money market account. We still see money going into bonds, and we see less money here, but still money going into equities or stocks at the same time. Then equity risk premium, and we try to measure this. It's like how much extra are you compensated for by taking on extra risk? And that's called equity risk premium. It's at 20-year lows, which is what we're seeing here when earnings risk is at 20-year highs. I'm not sure where they're getting that number from. This comes out from Morgan Stanley because earnings still seem to be going up and they're projected to go up. Now they're slowing down, especially with the mega cap stocks and the Magnificent Seven, but it's still looking pretty healthy. And we've got all this flux going into AI and new technologies and things. And we'll have to see if the earnings are able to pick up here. Then the financial conditions index put out by Goldman Sachs is dropping down and has been over the last year. And this is what's adding fuel to make available to go into the stock market. If we see this declining, that just means that there's a loosening of the financial conditions. Interest rates are still getting under control. There's more liquidity, and a lot of that money finds its way into the stock market. And the Magnificent Seven and the S&P 500, and even though the Magnificent Seven stocks, their earnings are growing, they're fading a bit here relative to the broader market. Now, that could be taken as negative, where maybe the Magnificent Seven stocks won't be running the stock market with as much impact as they've had before. That could slow down some of the indexes that we follow, like the NASDAQ 100, and I follow the S&P 500. But you could also take that as positive, meaning, okay, now it's being spread out across the broader market, across the rest of the S&P 500. Few interesting charts here. Mentions of AI earnings calls. So whenever they do a conference call after an earnings report comes out, they look for certain keywords and they're just measuring this here. And it's no real surprise. AI is the real buzz, and companies at all different levels and all different types of businesses are looking into, okay, how can we incorporate AI into what we do? Here's the intraday chart, and the bigger picture here is what's been developing so far for this week. We'll have to see how things play out on Friday. But we did gap lower over the weekend, and everything was like, oh my gosh, what's going on here? But we set the low right close after the open. And we've been just clawing our way back ever since. And right now we're at the high for the week. And we've been seeing pretty healthy action. And this is the smart money coming in and buying. That's why those indicators are starting to look rather positive. But in Thursday's session, we did open up positive. That's above the dashed line here. We came down to the unchanged level, which acted as support. We could not get above R1 until later in the day, but it was acting as resistance earlier in the day. Then we saw some weakness coming in here. We actually dropped negative, almost got down to the daily pivot, and then set up a little base of support here. And then this is the late day buying that we saw coming in, and that pushed us to close right at the daily high. And not much of a change right now in the initial overnight session. It'll probably be quiet. Of course, anything can always happen. But usually before the employment situation report, there's a lot of just, okay, let's fall back, wait and see how things actually end up unfolding. Still looking good with this chart with the blue line above the red line. That means on an intraday basis, large cap growth is outperforming large cap value. And we're seeing this too, going back into the latter part of January, where we bottomed out. This was the deep seek day when everything gapped lower and growth really took a hit, and Nvidia was down, what, 17%. We've been clawing our way back since then. So this is looking a little bit similar to the intraday chart that we've been seeing for this particular week. This is a little bit longer term, showing that growth is outperforming value, and that's more positive for the market. So growth was up in Thursday's session where value ended up being down. Growth was also up for the mid caps where value was down. And small caps, though, it languished. Small cap growth ended up being down more than small cap value. So looking at the small cap growth to value ratio did decline a little bit, but we're still in an uptrend overall. We're just kind of not really going anywhere as far as the index is concerned, just chopping around. We come down here, set a range for a while, then we go up, set a little bit higher range, but we're just not really moving with much enthusiasm currently. We are breaking out here with mid cap growth of value, although the index is not really showing that breakout. This really improved the S&P growth to value ratio. Again, we're not really breaking out based on price, but we are seeing an improvement with the growth to value ratio here. A bit of an improvement, but we're still down inside the rainbow when we look at the growth versus value ETF. Discretionary to staples, still showing how discretionary is outperforming. That's positive for the market. We're still above the 50-period moving average here with large cap growth. And then looking at our trend, this is where we're just not going anywhere. The ADX continues to decline below the moving average, below 20, but we are positive because the green line's above the red line. And then short term, green line above the red line, still declining below 20. We're trying to flatten out here a little bit, but that's in the short term. So this also shows that in the short and intermediate term, we're not trending. And then a week ago, we're not trending on the weekly chart either. And we're rolling over a little bit with our volume oscillator, but we're still above average. And we do every week get the reading from Investors Intelligence, pretty much neutral right now, coming in at 1.61. If we drop below 1 or go above 3, that's when we pay most attention to this. Coming down with the VIX, so that's been improving too, both on a closing basis and with the bar chart. And when the VIX is down, the VIX of the VIX, which measures the volatility of the VIX, it also is dropping. Still getting a high reading with the skew index, which is a variation of the VIX. The VIX uses at the money options to calculate its current value. where the skew index uses out of the money options. And it's just that the market is expecting some kind of a big move. But we've been in this red area for all of 2025 so far. And we're starting to go back down with the VIX as far as the momentum. That could be more positive. As we've been dropping back down here with the VIX, the MACD is starting to roll over and go negative, which is positive for stocks. Ticked up a little bit with this fear gauge, also pretty much flat with this other fear gauge. We did get another sentiment reading. These are individual investors. They really dropped down. They're looking a little bit more negative right now. We dropped back down below zero, and also the 50 period moving average is also declining, where it had been positive for pretty much all of the latter part of 2023 going into 2024. This is another breakout of that same survey. The white is the bullish um, sentiment, and then the red is the bearish sentiment. Then they do the spread between the two. This is pretty much what I'm showing on that previous chart. And then they look at an 8-week moving average here, where I look at a 50-day moving average. So clearly they kind of line up with each other that way. Okay, and then retail sentiment. And this is put out by JP Morgan. This could be a little bit of a concern where it's showing that folks are really positive on the market. Retail, which these are not necessarily the professionals. These are folks that don't necessarily really have a lot of experience and know what's going on in the stock market. And the fact that they're getting pretty extreme might be a concern. And then retail flows as a percent of aggregate market cap. Where's the money going? Well, down here, this is the S&P 500, even though that's what I focus on. They're not the ones that are interesting to talk about at parties, the boring stocks, a lot of companies you maybe never heard of. Where the NASDAQ 100, well, that's where the thrill is. And we're still seeing money going into the NASDAQ 100. Then looking at the daily chart of the equity put call ratio, it did go up. This could be some hedging ahead of the employment report coming out. So we're starting to tick back up with the 5-day chart, but we're below this red line, which on this chart, it's a green line, just meaning we're getting rather extreme. And we're also going up with the 10-day equity put call ratio overall. So we're seeing some more confirmation there. When this is going up, that means there's more hedging going on. The folks doing this are a little bit more nervous about market conditions. Actually came down a little bit below the band here with the volatility risk premium, as that continues to be pretty low. And we're still looking good here with the advanced decline line based on price and volume, not breaking out to any kind of new highs here, but we're still above these advancing moving averages. And we ticked down, but we're still above zero with the advancers minus decliners over the last 10 days. Showing some improvement here, but not positive yet with our 5-day or 10-day moving averages starting to flatten out here. But we did see an expansion of the new highs and a contraction of the new lows. And if we break to the upside, then this green line should continue to go up and the red line should continue to be less here. And that would improve things internally with the S&P. Ticked up a little bit here and still above zero with our short and intermediate term advanced decline ratio. This is one of the extreme readings that we're getting. Don't pay any attention to this down here. It's called the boom indicator, and it's supposed to measure how far away we are from the moving average, and you can see it's not picking that up. Where this is the indicator itself, and we are getting kind of far away from this moving average. So that's looking extreme positive. And we saw a big bump up here with the chicken money flow. Now it's positive, but when we get to similar readings of where we were, doesn't mean we're going to reverse. But when we had a similar reading here, at least we went sideways again. So we might be due for some more sideways action if the market can stay positive. Now, there are times when this tops out and we do see some weakness after that. And we're getting a really extreme reading here with the Chaikin oscillator too. Again, back in late 2023, we saw a very high reading, and it didn't mean we reversed. It just meant we slowed down there for a while. Positive with the vortex, the green line turning up just barely and the red line going down just barely, but the green line is on top, so that is positive. Not much of a change here with the cumulative advanced decline line for the S&P based on price or volume. A little bit more of an improvement. We ticked up a little bit here based on volume, and not much of a change with the cumulative advanced decline line for the NYSE or The regular NYSE advanced decline line, we're still above the moving average. Not much of a change, just chopping along, this more feeding into this non-trending environment right now. And bit of an improvement when we look at NYSE common stock based on price and volume. Still above the moving averages here with all the indexes, with the NYSE common stock, the S&P, the mid caps, and the small caps. Still above zero with our 5 period moving average of the highs and lows across the broad market, but we're still declining here. However, we're positive when we look at the stocks inside the S&P above their 20 period moving averages and ticking down, but still above 50 with the 50 period moving average steady, declining with the 100 period moving average steady, but still positive since it's above 50, and declining but well above 50 with the 200 period moving average steady. So the daily chart still above the 50-day moving average, not really doing all that much right now, but we continue to be above average with volume. Ticking down a little bit with our 20-50 period moving average study, we were flat with the 200 period moving average study. And this is also suggesting we're not trending. We have a number of short-term indicators. When we're moving in one direction or the other, it doesn't take much for this, the Stochc RSI, and some of the other indicators after this to give us an extreme positive or negative reading. Well, we're just about at the midpoint here. Williams percent R is improving, but not extreme, and we're above the midpoint with the CCI 14 and the CCI 20. But all of these together usually would be extreme positive if there was a lot of conviction behind this move. Going back up with the short-term stochastic, but not extreme. Turning back up in the intermediate short term, and also turning up, but still slightly below the moving average with the long short-term stochastic, which again is a further subdivision of the short-term time frame. Moving up a little bit above the midpoint with the force index, so that's positive. The condition of the short-term trend just kind of going along sideways here. We're not falling apart, but we're not seeing an awful lot of strength currently. But we are above the simple and exponential moving averages based on 20 periods. We're above the midpoint in the +1 channel with our standard deviations chart, so that's not extreme. This is looking kind of extreme though. The balance of power, we're getting up to this black line. So other times when it happened, it did not necessarily mean a reversal, but it just meant that things might slow down. Turning back positive though with the go no go. We have the darker blue bars now where they had been the lighter blue color. So that's picking up some positive action there. Above the midpoint with our highest high value chart. TTM squeeze still looking positive with the lighter blue bars, and it's going back up. Ease of movement was flat and still just barely positive. The Erin indicator is flat but positive since it's above zero, and ticking down just a little bit but still above zero with the S&P McClellan oscillator. So we're going up based on price, but we're still going down based on volume. So this is a negative divergence. And ticking down with the NYSE McClellan oscillator, but also still above zero. So we're going up based on price, and we're pretty much flat based on volume. That's a little bit of a concern. And then the Swenlin trading oscillator looked like it was improving. We were turning up based on price and volume. Well, in Thursday's session, we're ticking back down now based on price and volume. So that could be a warning sign. And momentum, and it can't help but start to show weakness if we continue to chop along in a trendless environment. But we're still positive here with the PMO, positive based on price, coming down to the moving average based on volume, and just kind of chopping a little sideways after declining and then trying to bounce back up with the PMOs that are rising. We're still declining with the buy signal, still slowly going up with the PMOs that are above zero. We're positive though with the Elder's Impulse system for the S&P with a green bar, but we're negative with the parabolic SAR since the dots are on top. And here's the short-term oscillator, the slope oscillator, starting to come back above its moving average, but pretty much going sideways, but above this green line. That's why it's extreme positive. And we were showing some weakness with the MACD, which is more short to a little bit intermediate term. This is still positive. It's trying to turn back up. So then I plot a number of different oscillators on this chart. Two short-term oscillators, which are still just kind of chopping sideways. Seeing a little bit of an improvement here with our three intermediate term oscillators, and we're still positive with our long-term oscillators. Copy curve rolling over and could be getting ready to go below the red line here. So that's a little bit of a concern there. But we're still positive with the Sean trend meter, above 50 with the ultimate oscillator and with the money flow, above the moving average with unbalanced volume, above 50 with the RSI 14 and 9. Rolling over a bit here, but the Pring bottom fisher, we're still working off of a buy signal that was generated not too long after the beginning of 2025. The condition of the intermediate term trend based on 50 periods also just kind of going sideways right now, but we're above the simple and exponential moving averages. So that's why we're positive. Here's all of the different moving averages, and we're above all the moving averages on this chart. That's why I say we're positive in the short, intermediate, and long term. Balance of power improving, could be getting ready to turn back positive. It's starting to cross back above its moving average. Ticked up here with the NYSE bullish percent index, and this is encouraging. We're seeing the NASDAQ 100 bullish percent index going up. So that was a little stronger move up on Thursday. But longer term, we have this trend line here going back to 2009 that we're just not able to get above, at least yet. And we're positive here with the Heiken Ashi with the open candles. We're negative but pointing up with the Kigi chart. We're positive with the Renko chart. We're still positive with the three-line break chart. So not across the board confirmation, but we're still looking more positive. Longer term, just kind of chopping around with our 150 and 200-day moving averages above these blue lines here. So they're still positive. Positive across the board and on all time frames with the different stock indexes that we follow. Bonds are still positive in the short term based on price. Commodities are positive across the board, and the dollar is still in a short term downtrend. And we saw utilities, healthcare, and energy. These tend to be more defensive areas. Those are the ones that underperformed. Where financials doing quite well. Now, staples, that's also another defensive area there. Communication and discretionary, we want these to do well. Those are more growth areas. And then the big growth area is tech itself. Not an awful lot of alerts. We had the industrials have a BPI cross below 50, and then the NASDAQ got above 19.7, and then tech had a bullish MACD crossover. So that could be positive there. But most of these happened right at the open, and then we just kind of floundered sideways for the rest of the day. And we were going up with the S&P weighted version of the index. We actually declined here with the equal weighted version. So this was more the mega caps leading things in Thursday's session. The Dow just kind of chopping along sideways here, but still looking positive, but neutral with the diamonds when looking at the Elder's Impulse system. I want to keep an eye on semiconductors here. We came down to this 250-day moving average, and we're holding it above that support level. That could be encouraging there. And then the NASDAQ, it was up over 0.5% here above its 50-day moving average. We were also up over 0.5% with the NASDAQ 100. These were the stronger areas. Where they underperformed on Wednesday, they outperformed on Thursday when we were talking about the mega caps and the NASDAQ 100 and the NASDAQ. And we're still positive with the Elder's Impulse system for the Qs. Momentum is trying to turn back positive here. We've been flatlining lately with the NASDAQ 100. And now we look at the small caps where the 50-period moving average is still acting as overhead resistance. We were not able to get above that. And they were actually down in Thursday's session. But they're still positive with the Elder's Impulse system for the small caps. And we came down and closed right on the 50-day moving average with the other small cap index that we look at, the Russell 2000. And above the 50-day moving average with the mid caps here, but really not breaking out, just kind of going sideways. They were virtually unchanged, but still positive with the Elder's Impulse system for the mid caps. The Wilshire, a broad market measure, it was up 0.29%, still above its 50-day moving average, still in a longer term uptrend. And also the total U.S. stock ETF is hanging in there above its 50-day moving average. Financial sector was up 0.83%, still looking pretty solid there. The FANG index was up 0.69%, still looking pretty solid there too. These are the big mega cap stocks. So Apple was up 0.33%, still below its 50-day moving average. Amazon up over 1%, looking pretty solid there. Microsoft still below its 200-day moving average, but it was still up on the day. Google was virtually unchanged. It's hanging out a little bit above its 50-day moving average. Meta up over 1%, looking really solid there. Nvidia getting back above its 200-day moving average, up over 3%. Tesla declined over 1% and falling below its 50-day moving average. And Netflix up, setting another new all-time high. And a little bit of a tick up here with the short-term correlation between US and world stocks, but we're flat with the longer-term correlation. Oil's dropping down. We're getting into the 70 range now. So as that's been falling off lately. And now I still have us in an uptrend here with the dollar, but we're coming down and dealing with the 50-day moving average currently. And then looking at interest rates, we did tick back up here, but this is what you call an inside day, where Thursday's action didn't exceed the previous day's high or low. It was contained inside the previous day's bar. And this is the intraday chart that I've been following here, where in Thursday's session we gapped down and actually opened above the 4.5% level. We're still below that. So we'll be watching this. If interest rates really start to go up, will this 4.5% level provide overhead resistance? And looking based on price, showing an improvement here, but we did tick down from Wednesday. And we're keeping an eye on the 10-year bond in Japan. This is continuing to go up. Is this going to cause some kind of problems with the carry trade, similar to what we saw last summer? And our growth to value ratios showing a little improvement with the Qs to S&P. Discretionary is looking solid here, but when we compare it to the S&P, it's dropping below its moving average. And we're still below a declining moving average when we compare large cap growth to value. So the large cap's still below the moving average. Mid cap's looking pretty strong here and coming down, but still above the moving average with the small cap growth to value ratio. So what's our outlook? I didn't change anything here. We're positive and we're still seeing some improvements, but we're not trending right now. We're going to get the big report, the employment situation report, consumer sentiment, which can also have an impact, as well as wholesale inventories and consumer credit. And then all the crazy stuff going on these days with pretty much everything focused on what's going on in the US. Of course, that drifted over into the Middle East with the whole Gaza talk that we're hearing about lately. And here is the finishing up of the economic calendar for the week. Here's another look at the economic calendar and what the readings were previously. Seasonally, not much of an edge, but we do have a slight bend over to the positive side. We're neutral to positive with the Dow, S&P, and NASDAQ for February 7th. And still looking at the first half of February, which does better than the second half of February, but it's not one of the best performing times of the year. And this also shows February isn't a fan of post-election years. This is not very good right now. But it's within that window from November to April of that good time when it tends to be more positive for stocks. And then early February, going up till the midpoint here, that tends to be more positive than the second half of February. But during an election year, February is one of the worst performing months. And small caps, just not really living up to what seasonally and historically has happened. So the parabolic SAR is still negative. Both the 5 and 10-day equity put call ratio charts are going up, but we're just kind of ticking up. We have a good reading there and they could easily tick back down, but at least they're both going in the same direction right now. Could be some hedging going on ahead of the employment situation report. And we have this mass index. I'm not showing the chart anymore, but because it's been triggered now for quite a while, but it thinks that we might have a reversal. And what led to that chart actually triggering was we were going up. So it might suggest we could be going down, but we're not really seeing much confirmation from that in our other charts. And we're turning back negative again with the Swenlin trading oscillator. We're going down based on price and volume. But when we look at the smart money indicators, we're extreme with all three right now, but they are positive. We're looking good with the growth to value, discretionary to staples ratios. The advanced decline lines are showing some improvement there. The ease of movement is positive. We're still declining with the summation index for the S&P. based on volume, and that's producing a negative divergence there. We're showing some weakness with the momentum. In fact, the Copic curve could be getting ready to cross over negative, but we're still positive when we look at our other momentum oscillators. We're showing some improvement with the bullish percent indexes, especially the NASDAQ 100. The Vortex is improving as well. The money flow and ultimate oscillator are positive. Our moving average studies are positive, but they all declined in Thursday's session because it was just a few stocks that were really driving things up as we worked our way into the close. Financial sector is positive, and we're just barely turning back up after flatlining with the momentum of the NASDAQ 100. So our conclusion, we're positive. We're still seeing some improvements, but we're not trending. And this is becoming a bit of a concern. The smart money indicators are extreme positive, and that's what I have listed here in the short term. We're in the intermediate term, we're still positive, but we're not trending, and we're seeing some improvements there, and we continue to be positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.